Okay, so we're into chapter 23, which is about standard costs and what are called cost variances. So again, I was looking at like the textbook publisher. I'm always stealing their slides, so I don't have to make all these slides. For this chapter, they had like 95 slides or something like that. And I'm like, that's horrible. Like, and no, like who could sit through that presentation? Like, and so as usual, I tried to trim it out to the things that I think matter. That being said, hopefully I cover everything we need to move forward here. So there's the risk in trimming things, right? Is sometimes someone will be like, you didn't cover that. Please remember that sometimes you have to read the book. Like in a 30 or 40-minute lecture, I can't cover everything, right? So you'll have to refer to the book. And also refer to the helps and things like that in the problems. So I mean, you guys know that we're well into this course and you all are doing well. So but this chapter I think should be pretty straightforward. So let's go ahead and jump into it. This thing's not going to work. There it goes. All right. So in managerial accounting, so when we're using accounting for making decisions, a lot of times we use something called standard costs. And standard costs are kind of like exactly what they sound like, which is like, how much do we think a product should cost? We call that its standard cost. We recognize that the process of creating products, whatever they are, is not perfect, meaning we won't always exactly hit our standard cost, but that's, it's based on what we think the direct materials that are going to go into it and the direct labor that are going to go into it and then the overhead that's going to go into it, right? We use that as a standard. And what we can do is once we've developed a standard cost is we can compare it to the actual cost and then ask ourselves, well, why are we different? And is there something we can do about it? So this happens in almost every industry, even here at the college, right? We would want to say, well, how much does it cost to offer, a class of accounting? We have the cost of the teacher, we have the cost of the overhead, and then, at the end of the year, we can say, well, how much did it actually cost us? And compare those two. And if we're way off, like especially in an unfavorable way, like why did it cost so much more than we thought it would? We can look at that and we can start to make some policies to help us mitigate that. Or if in the other direction, we find that it's favorable, we can say, well, how do we repeat that? How do we keep our costs lower than the standard? And in time, maybe even we would adjust our standard lower if we consistently were hitting that target. So the difference between our standard cost and our actual cost, we call a variance. And so in standard costing systems, there's all these they're called variance reports, or how much or what actually happened different from what we would expect to have happen. So here's an example of standard costs for a company that makes jeans, XL jeans. For me, it'd have to be like 2XL jeans because I'm a little beefier. But so for them, they know their direct materials, that there are the standard price is $5 per square yard. And the standard quantity per pair of jeans is 1.5 square yards. So their standard cost in materials is going to be $7.50. So recognize that if either A, they got a different price from their supplier on the material, right? Or they had to use a higher quantity. Maybe they had more waste. Has anybody ever sewed stuff? Some of you? Okay. So you know that as you get better at it, you have less waste, right? When you first start, or even like, anybody ever wrapped a Christmas present? And your mom's like, what are you doing? You wasted all that paper, because she's been wrapping presents for like 30 years and she knows how to like put it right in that little corner and get it exactly right. But like you have to do all this extra because you're not sure, right? This happens in businesses. And sometimes if we hire a bunch of new operators, we're going to have more waste at first until they get good at the job, right? I mean, all sorts of stuff. So a change in the price or a change in the quantity, either one of those is going to lead to us being off of the standard. Does that make sense? So that's why we care. Okay. Direct labor, our standard is $9 per hour. I don't know how we do that, but, and it takes 0.8 hours per pair. Again, if we have people that we're paying above that or below that, or if it takes longer than we thought, any of those could lead to us being off of standard. And then overhead. Remember, overhead gets allocated, and so this one's a little bit different. But if our total overhead costs are higher, then it's going to lead to a higher allocation off of standard. So the idea is we want our accounting department together with our managers to develop a set of standard costs, so that then as we actually do work, we can compare to that and see how close are we to our standards. All right. Sounds a lot like budgeting, right? It's another form of budgeting if you think about it. All right. So the difference between actual and standard costs are called cost variances. And I love, they put in this whole slide to be like, if standard cost is higher than actual cost, or if actual cost is lower than the standard, we call that a favorable cost variance. Yeah. And if our actual costs are higher than our standard costs, we call that an unfavorable cost variance. Thank you. Nice slide, guys. Yeah, I think that's weird too. And what's the other thing is, you know, I just told you I cut a bunch of slides out, but I chose to keep this one in, I guess, because it does very clearly tell you the difference between the two. Actual costs lower than standard, that's good, favorable. And if actual costs are higher than standard, not good, not favorable, okay, unfavorable. All right, so here's Western Rider Inc. They produce the following pair of jeans. They have 5,000 pair. Their direct materials are 40,150. Their direct labor is 38.5. Their factory overhead is 22.4. So their total costs incurred $101,050. So here's our data. So with that data, what you would then do is you would produce this document, which is called a budget performance report, or sometimes it's called a cost variance report, or you'll see different names for them. But in essence, you'll have direct materials. So here's our actual cost, and then our standard cost at the actual volume. So we take 5,000 pairs, that's the actual volume, times the standard cost, which was $7.50 per pair for direct materials. So that gives us, in essence, what we would expect our direct materials. So in this case, our actual costs were higher than our standard costs. So we would say that we had a $2,650 unfavorable variance. So that would lead us then as managers to say, well, what led to that, right? Why did we spend $2,650 more on materials for this run of 5,000 jeans than what we thought we should? And we could probably trace that down pretty quick, because it would either be that we had a higher cost per yard of material or more material per pair of jeans being used, one of those two, honestly. And so by doing this broken down by direct materials, direct labor, and overhead, it can help us pinpoint issues pretty quickly, right? And then the question is there anything we can do about it? Like right now, if we're spending more on cloth or something like that, is there much we can do about it? Not really. That's just, you know, everything's more expensive right now. Direct labor, their actual cost was 38.5. Again, they take 5,000, the actual volume times the standard cost of 720 per pair, and that gives them $36,000 in standard cost. So again, $2,500 unfavorable variance. Again, so the question is, are we paying more per hour of direct labor than what we had as our standard? And guess what? Minimum wage is going up. I bet you a lot of companies are having to adjust their standards, right? Or are we putting more time into? And so again, the intent is for us to figure out from the variance, is this something that's controllable or not controllable? Because if it's controllable, we need to control it. That's what management's all about. If it's not controllable, then we need to adjust our standards and say, have you ever done that on like when you've made a budget for yourself where you've like like for whatever weird reason, you like lie to yourself and like pretend like you're not going to spend money on something, but you really are going to spend money on it, kind of. And then later on, you just have to finally be like, I just need to adjust my budget. Like if I'm being honest, I'm going to go out to eat once a week or something with my friends at lunch. And so I just need to plan for that, you know. But I think in the beginning, you're not really lying to yourself. What you're saying is, I'm going to be strong and I'm not going to do it. But like, so I think, believe it or not, you would think that businesses would be immune from that sort of thing, but it happens everywhere. It's just human nature to sort of like think you're going to be more disciplined than you are, and then real life hits you and you realize, I'm not as disciplined as I thought I was. And so your choices are either to become more disciplined or to adjust your budget or your standard cost in this case to consider those things, right? To build that cost in so you have a real good estimate of what's going to cost you. Factory overhead, they had 22.4 in actual cost, standard costs were 24,000. So they actually had a favorable variance there. So their total manufacturing costs, they had an unfavorable variance of $3,550. And again, the things that could cause that are relatively limited. And so you could probably track down pretty quickly, decide what's controllable, what's not, and then move forward. That's the intent of this, okay? So they use these big terms, which I'll go over to describe what I just described. So our total manufacturing cost variance is made up of our direct materials cost variance, our direct labor cost variance, and our factory overhead cost variance, okay? And our direct materials cost variance is either made up of what's called direct materials price variance or direct materials quantity variance, which is, those are the fancy terms, which mean exactly what I just described. Price variance would mean my direct materials are costing more than I thought they would when I made my standard cost. And direct material quantity variance is that I'm using more direct materials than I thought I would when I made my standards, right? It could also be less, by the way, right? Because you can have a favorable variance and then be the same thing. You'd be like, is this controllable? And if so, how can I continue to have this favorable variance or even make it more favorable? Direct labor variance is made up of either direct labor rate variance. Am I paying more or less than what I thought in the standard? And direct labor time variance. Am I spending more time or less time for each unit I'm producing? And finally, factory overhead cost variance. We can have variable factory overhead controllable variance, and then fixed factory overhead volume variance. Okay, and we'll look at each of these a little bit. So this is a little confusing when you first look at it, but after you kind of break it down, it makes sense. So here we have our actual cost, which is our actual quantity times our actual price. So the number of units we produce times the cost per unit. Over here, I'm going to skip the middle for a minute. We have our standard cost, which is our standard quantity times the standard price. And then in the middle, we have our actual quantity, but times the standard price. So this is always how we break down variances. So our direct materials price variance is going to be the difference between our actual cost and our actual quantity times the standard price. So that's going to be a variance based on the difference in the price of the materials. Our direct materials quantity variance is going to be the difference between our standard cost and our actual quantity times our standard price. So the only difference here is going to be the actual quantity from the standard quantity. Does that make sense? And then together, the difference between our actual costs and our standard costs is our overall variance. This is one of those things that the first time it was sort of presented to me like this, I was like, because I'm not super visual. Okay, like I would almost prefer things presented to me like in a table with just the data. And that this sort of visual representation was hard for me. But like now that I've worked with it more over time, it really helps for me to see the relationship between those two direct materials, price variance and quantity variance, and the overall variance. If it doesn't work for you very well, it's okay. Use the table like I gave here. But for some people, this sort of visual layout helps them. So recognize that it's kind of the same information being presented from two different ways of thinking about it, I guess. Direct labor variances, we can sort of build those or look at those relationships in the same way. So again, on the left, we have our actual cost, which is our actual hours times our actual rate. On the far right, we have our standard cost, which is our standard hours times the standard rate. And in the middle, we have our actual hours times the standard rate, okay? And if you think about what this means, the actual hours times the standard rate, it means we know how much time we actually put into it now. So at the standard rate, this is what we would expect the cost to be. So the difference between the actual cost and the actual hours times the standard rate is going to be the rate variance, right? Because we have actual hours are the same. So it's going to be the difference in rate, or in other words, the difference in how much the labor cost us. And then the direct labor time variance is the difference between the actual hours times standard rate and the standard cost. So the thing that's different there is the actual hours from the standard hours. So that's what we're going to call time variance, meaning we spent more or less time than what the standard was doing it. All right. So a factory overhead cost variance report is sometimes useful when, so those that was direct materials and direct labor. And remember, overhead's this weird thing because it's an allocated cost. And so it's a little bit different when we're figuring out difference in costs, because all we're doing is taking those overheads and like dividing them up among the products, right? So an overhead cost variance report is a tool we can use where it has the budget and actual cost for variable and fixed factory overhead, along with related controllable and volume variances. So this is kind of what one looks like. So you'll see like the variable factory overhead costs, and they have it broken down to indirect factory wages, power and light, indirect materials. Then they have the actual cost, the budget or standard cost, and then the variances, whether they're favorable or unfavorable. Here in the fixed costs, you can see there was no variance because they were fixed. In other words, usually with fixed costs, there's no surprises, but we know there's like some things that we call fixed costs that are really probably like a mixed cost, something like, let's say the electric bill. We have an estimate, but probably if we were to produce more product, our electric bill would be a little bit higher, right? And so sometimes it's not as clean as that, as all the fixed costs perfectly work out. So we have our total factory overhead cost. We can see there's this difference. And then we can see that 4,200 of it was favorable variance from the indirect factory wages and the indirect materials. 200 was an unfavorable from power and light. So they called power and light a variable cost on this one. So our net controllable variance here is $4,000 favorable. So again, that would lead us to ask the question, well, what did we do that led to us having a favorable variance, right? And is it something we can repeat? So that's what the report looks like. And then this is kind of how they break it down in this more visual way. So factory overhead, on the debit side, we have actual factory overhead or actual costs. On the credit side, we have applied factory overhead. That's taking you back to early chapters. You may have to review a little bit. So we have what's actual and what was applied. And then in the middle, we have what was budgeted factory overhead. So variable would be that standard cost times the actual, okay, and then the fixed. So the difference between the actual and the budgeted, we call the controllable variance. And the difference between the applied and the budgeted, they call volume variance. And then the difference between all of it is the total factory overhead cost variance. Again, when you get into these, you'll find that this is not super complex. It's really just looking at what was budgeted, what was it actually, how different was it, right? And was it favorable or unfavorable? Sometimes we're asked to do an income statement that sort of breaks down the variances. So you'll see at the top, it has sales, cost of goods sold at standard, and the gross profit at standard. So that tells you what you would expect your cost of goods sold and gross profit to be. And then in this middle section, they'll actually have the variances from the standard cost. So you'll see the direct materials had unfavorable, direct materials quantity. So they're actually breaking it down into the price variance, the quantity variance, the direct labor rate, direct labor time variances, the controllable factory overhead and the factory overhead volume variances. And then you'll come out with like a net variance, which is just the net of all these. So then what we'll do there is we have 140,045 minus 3550. We come out with our gross profit, I guess, actual. And then the operating expenses and the operating income. So this is just a way, I really think we would use something like this when we have a boss who's comfortable with what an income statement looks like. So we're trying to create a report that shows the variances, but puts it into the income statement format. Because what this does is it says, here's what we'd expect gross profit to be, here's what gross profit really was, and then here's what led to the difference between the two. Does that make sense? And I think that's actually pretty valuable to me as a boss. If I'm looking at that and going, okay, so given the level of sales, we expected a gross profit of 42.5, but we had 38,950. Well, what led to that? And I can see real quick, price variance in the direct materials, rate variance in direct labor. So we're paying more for direct labor than we had originally planned. We're paying more for materials than we'd originally planned. We're actually getting some positive variance from the quantities and labor time. So we're doing well there. So again, what's controllable? What can we do about it? And then we make a plan and move forward. That's part of controlling. One last thing, we don't just have variances on costs. We can have variances also on our revenues, right? Again, we expect that we're going to sell a certain amount of stuff and that we're going to be able to sell it for a certain price. And so our planned revenue, or our standard revenue, sometimes it's called, is our planned selling price or standard selling price times our planned units of sales. So this business thinks they're going to sell 100,000 units at $8 a piece. So their planned revenue is $800,000. Their actual revenue, again, I don't know why they set this up with the, if you remember the ones for costs, they had the actual on the left and the planned on the right. This one, they did it here. I think probably because they're thinking in terms of like journal entries and revenues get entered on the right, but it's certainly not a T account. I just thought it was interesting that they set it up differently. Actual revenue on the far right, our actual selling price times the number of units we sold. So we can see that we sold it for less than the planned price, but we sold more of them. And then in the middle, we have the planned selling price times the actual units. So same way of thinking about it, okay? So we can see in this case that if we look at the total variance, we made more revenue than we thought we would, right? The other thing to recognize is, and maybe that's why they also switch sides, is it's favorable to have more revenue than you planned, whereas it's unfavorable to have more expense than you planned, okay? So we had a positive variance here of 137,500, or a favorable variance. They show it as negative actually, but it's favorable. We had more revenue than we planned for. But if we look here, based on volume, okay, we'll see that we sold 25,000 more units than we planned. So the difference between our planned revenue and our planned selling price times the actual units of sales, which is our revenue volume variance, is favorable because we sold more units than we thought we would. But our price variance is unfavorable. Why? Because we sold the actual selling price was less than what was originally planned. Okay. So I hope that this leads you to not being too afraid of this chapter, that you can just jump into it You know, and it really honestly is just about the difference between our standard or planned prices and costs and revenues and our actuals, and then finding the variance between them. And that's it. All right. All right. Have a great day. That's all I have for you. I mean, you can work on stuff. You don't have to leave, but you can if you want to.